Hi, this is David Roche, Independent Strategy and Quantum Economics. I want to talk to you about bond yields. I think they have an enormous message for the future. They've collapsed. If you look at the US bond market, which is after all the biggest, and I'm sure US denizens think the best in the world, 10-year yields are now down to 117, 1.17%. And if you look at the 30-year yield, you're down to 186, 1.86%. If you think that the economy is growing in real terms at 6% and that inflation is probably adding another 3, call it 9, 10%, then the relationship between bond yields and nominal growth are phenomenally out of line. Because theoretically, the bond yields on risk-free assets, which are going to be redeemed by the government one day, should reflect the underlying rate of return on assets. And certainly, these level of bond yields and this level of nominal growth in the GDP do not reflect that reality. Now, if you go to other places which are financially more solid than the United States, like Germany, the 10-year Bund yield is at minus 0.44%. So you're paying the German government to take your money off you for 10 years. And if you go to Italy, which we know is going to finish this year with government debt to GDP ratios of over 165%, then you get paid a miserable 0.57% each year for 10 years to buy an Italian 10-year sovereign debt. Okay, now let's think about this. Can it last? And the answer, bottom line, is no, it can't last. And when it reverses it, it's probably the major signal for optimism about markets, optimism about the economy, and above all, optimism about inflation. And that is down the road. I can't say to you it's going to happen in the next 2 weeks, but happen it will. Let us think for a second about what drives bond yields, and we'll focus on the US for the moment. Well, the deficits, the amount of money the government has to borrow, the US savings rate, and the difference between the two, which is how much the US has to borrow abroad, is a key variable because it determines the supply and demand for bonds. Now, right now at the moment, when the world is in a risk-off investment mode and when people believe good news will continue to dominate in the US in terms of the Fed continuing to print money, and in terms of the US government continuing to spend it and growth continuing to boom, people are putting a lot of money into the US. And because they are, that makes the twin deficits, the budget deficit and the external deficit of the United States, easy to finance. That will, however, not always be the case, because anything that goes wrong in optimism about the US will affect the flows of money into the US and lead to a rise in bond yields. The second thing to bear in mind is that bond yields are themselves, even right out in the long maturities of the yield curve, are effectively the result of monetary policy. Not only is the Fed buying bonds, it's much more important than that. It is printing money as a result of buying those bonds. That money predominantly flows into banks and is kept as excess reserves with the Fed. Excess reserves with the Fed don't earn any real money. So what happens is that the banks, the commercial banks, take that money out of the Fed and put it into government bonds out the yield curve, depressing the yields on those bonds, but giving those banks a higher rate of return that they get on the cash being printed by the Fed if they kept it in excess reserves at the Fed. So that's another reason why bond yields are where they are. Now, the third reason is, of course, and it is really probably the most dominant in the longer term, is what drives inflation. Now, at the moment, of course, we're being told by the Fed, nothing drives inflation, it's all transitory. Now, the most inflation-prone thing in the world is actually the word transitory, because like Robert Graves' definition of hell, it is words repeated endlessly until they all but lose their meaning. In reality, if you look at transitory, there are far too many things which go into judging inflation, which are themselves core and not transitory. They have actually changed. One of them is the fact that labor markets are not matching up in supply and demand. we're supposed to have an excess supply of labor of 8 to 10 million people in the United States. And yet, if you look at the surveys of corporations, whether you look at small and medium-sized corporations or big corporations, the major problem they have about getting output up is a shortage of labor. So essentially, supply does not equal demand. And therefore, the measures of output gaps, the measures which the Fed uses to justify the fact that, or their belief that inflation is transitory, that measure is actually does not match up in reality. So that's one thing I would say about it. The second thing I would say about it is that, of course, there is scarring, leftovers or legacy costs of the pandemic, which means that people will be demanding goods and services which are different before the pandemic, and therefore the supply and demand in the sectors which are subject to an increasing rate of demand, they will very quickly result in increased prices, as we're seeing in the service industry at the moment. And in the other sectors, which are kind of the has-beens of the pre-endemic era, we will see there being no price pressures. But the net effect is that in terms of demand growth, there'll be plenty of price pressures. And finally, if you look around the world, we monitor about 25 economies around the world. All those economies, 22 are actually seeing high rates of inflation. And many of them have central banks which have already tightened, which leads one to ask the question, well, is this just about the US or is it a worldwide phenomena? And it's not about any single cause, but just inflation is coming back in so many places. Why is the Fed the only central bank to actually kind of be afraid of talking about reversing monetary policy to reflect the realities of today, which is that inflation is there and it's widespread in the world? So that's why I would say that the word transitory is really one of the words which is grossly misused and overused. But now coming to what's going to drive inflation in the future, which I think is perhaps the most important thing, let us think about how the world post-pandemic differs from the world before pandemic and how this could influence inflation. I would say there are probably four things that should be taken into account. Number one is big government and big debts. That means that the role of government is not going to shrink just because the pandemic goes away. It has grown, meaning government spending as a percentage of GDP, by approximately 1/5 during the pandemic. It is most unlikely that either the politicians or the bureaucrats will ever reverse that. But however, they cannot finance it from taxes because that would make everybody very, very unhappy. So how they finance it is by going to the central bank, which is the second element I think should be taken into account, and financing their lack of their budget deficit effectively by issuing bonds which the central bank then in one form or another buys. So when we were younger by a couple of years, central banks were independent of governments. Now they're not. They basically are the financing arm of governments. They print the money and give it to the government. The government gives them bonds, and then the government takes that money and spends it. I don't think that is going to go away, but what it tells you is one very important fact, and that is governments and central banks will act as partners in trying to hold down inflation, because if inflation does rise, then the cost of their debts will rise, and we will quickly move from an era of complacency about sovereign debt to worrying about whether sovereign debt is sustainable, which it probably is not in the longer term. So there are two elements you want to bear in mind. Now, another area is the lasting heritage of the pandemic is going to be inequality. And the shift from laissez-faire liberal market economics as being the kind of Bible in hand of governments all around the world to interventionist governments, not necessarily of the extreme populist sort, though there are plenty of those about, but to the kind of center-left governments, marks a big commitment by those governments to addressing the issues of inequality. Inequality is, of course, how does it occur? Well, it occurs because the people who lose their job in the pandemic, as we've discussed, do not get them back easily after the pandemic. The jobs required after the pandemic are highly skilled jobs. The jobs which are lost were lowly skilled jobs. And the problem is that this means that the highly skilled people, and indeed the owners of capital and technology, get richer and richer in relative terms compared to the less skilled people which form the masses. Now, as that occurs, the center-left governments, in order to stop that trend of inequality turning into a populist vote, which would actually lead to their overthrow and to an even more crazy set of economic policies than we've got already, what they do is they try and address that inequality. And what they will do to do that is they will continue to pay some form of social income to iron out the huge differences in Gini coefficients for income and wealth between the haves and the have-nots. What that means is, as we have seen during the pandemic, people get paid not to produce, but actually they get paid in order to essentially keep some semblance of their living standards intact. I think going down the road, that's not going to disappear. In one form or another, governments are going to have to distribute wealth to the less wealthy. They're going to have to distribute income to those who are at the lower end of the income scale. They're going to have a big problem doing that through taxation on successful people and successful owners of capital. So what they will do is they will actually print the money and transfer it in the form of government transfers to the less fortunate or the less skilled. That does not actually change the real distribution of income or wealth. What it does is create the inflationary illusion of income and wealth differentials being bridged by government largesse. So implicit in what I've just said is that inflation comes back. And with it, of course, bond yields go to the dogs. Now, if that were all, it would be bad enough. But there is one other aspect. We're moving in line with that philosophy of government. We're moving towards nationalist economic policies. That means that economies, companies are run in order to provide income and jobs on a national scale rather than on a globally competitive scale. What that does is to reverse globalization. Now, globalization is not the most popular bit of history from the last 25 years because it resulted in large inequalities and people did not benefit in any way justly or equally in an equitable fashion, let us say, from the benefits of globalization. But what globalization did do is add enormously to productive growth, the ability to grow productively worldwide by bringing huge slices of labor force into the market economy, those who were behind locked in gulags in Russia or were in the Maoist hell of China. But it also brought capital for those people to work with on a global scale. In other words, the supply chains of corporations were not national, they were global. The goods flowed from China to the end markets. Now, there were a lot of things, as I said, from a social point of view, which were wrong with that model, but what was not wrong with the model is that the competitive pressures of globalization held down inflation for 20 years by a lot, like 1 to 1.5% a year for manufactured goods. Of course, there are reasons to reverse globalization, which are not all to do with political populism, nationalist economic policies, or even the US Cold War with China. It is because these supply chains have now been shown to be extremely vulnerable to the pandemic, vulnerable to blockages of the Suez Canal, vulnerable to disputes between nations about geopolitical issues as much as about trade issues. So globalization, which was already waning before the pandemic, is, I would say, now in reverse terminally. And this will not only reduce growth all around the world, but it will also boost inflation. So if you take those four factors together, big government, big spending, big deficits, and the financing of it directly by central banks, if we take inequality and the role of explicit or implicit social income, and if we take the return to nationalist economic policies and the reversal of globalization, I would say that these are much more important drivers of inflation over the next 5 years than arguments about excess money printing, though they are real, or about output gaps, supply and demand balances, though they too are real, but they do not, in fact, support the argument for eternally low inflation and bond yields where they are. So if you want to buy bonds today, I'm afraid I won't join you. I would be extremely careful of fixed income securities, even of the developed countries, even of the supreme US dollar, which is after all the reserve currency of the world. And I would say that the reversal of bond yields, which is out there not very far away, is going to be the moment when equity markets also reverse. And the reason for that, very simply, is that the discount factor by which future profits are discounted back to a value today, which is their market value, the discount factor goes up when the long-term yields go up. And that, I think, means that the coming rout in bond markets will not be confined to bond markets, but shared with equity markets.